Citigroup has something called the Economic Surprise Index, and lately, that index has tumbled. What does it mean, and what does it mean for your money? Welcome to Trading Nation. Bill Baruch with iiTrader, Chad Morganlander with Washington Crossing Advisors. Chad, do you put much, first off, do you take a lot of stake in this Citigroup Surprise Index? And if so, what is it then telling you about the stock market and the economy?
Well, I do actually put a lot of stake in that. I believe that overall, you're starting to see a deceleration of growth. We're seeing it within our own proprietary barometer, in which we track 30 different indicators, and we're starting to see a deceleration. So overall, what we believe will be happening over the course of the next 6 months is you're going to start to see financial conditions tighten a bit. It doesn't mean that it has to be a scare for a recession or just rather just a general deceleration. So we would start moderating our equity exposure from overweight to perhaps more of a balanced equity exposure within a portfolio, and maybe perhaps also extend your duration on your bond portfolio, because you could actually start to see additional flattening within the yield curve over the course of the next 3 to 4 months.
Does that mean you're selling some stocks?
Yeah, that would mean that over the course of the next 2 months, if you continue to see a deceleration or within the overall conditions of the financial system or the economy, that you should start layering out the risk, taking some chips off the table, and becoming much more balanced within one's portfolio.
Okay, look, getting a little more cautious, watching that. Bill Baruch, same question, do you watch that index, and do you agree with Chad's take that maybe we got to start taking a little profit in our winners and just get a little more cautious?
I'm a huge fan of this index, but I look at it from a different perspective than Chad. I trade a lot of currencies, and when you look at the index, when it goes low, the dollar index is low. If you look back in history and you find that index into the -40, -60 area, you want to buy the dollar. And on the inverse side, if it's in the +40, +60 side, you want to sell the dollar. This thing trades off perception, and right now the perception is very negative about hard data. Hard data has been just about awful, but the Fed has been very positive over the last week, talking very hawkishly, and that's really gotten the dollar to try to bottom. If the hard data can come around, the dollar index is about to rally about 2%. I think there is a very high probability that we see that, and I think there's a very high probability with the Citi index so low that we will begin to see that hard data come around here over the next 2 weeks.
All right, something to watch now. Yet another index. We've talked about it on CNBC. We don't highlight it a lot. Maybe we need to. Sounds like both you guys do like to watch that index. Chad and Bill, Thank you both very much. Folks, thank you for tuning in. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.